All right, stop scrolling for a second, because something violent just happened in silver, and if you blinked, you missed a 12% move in a single day. Silver went from roughly $78 to around $90 an ounce in hours. That's not a typo. That's after collapsing from near 120 in basically one session. And here's the wild part. This didn't come from collapsing demand. This came from mechanics. At the same time, the US just announced a $12 billion critical minerals stockpile and is hosting a ministerial with over 50 nations. Both policy and price just snapped at once. Stay with me, because I'm going to show you what's actually happening right now and how you can recognize this pattern the next time it shows up. If you're watching this video, you're ahead of most people who think they understand commodity markets. Your job right now is to understand the difference between a move driven by sentiment and a move driven by forced liquidation, because one of those creates opportunity and the other creates traps. Before I explain what caused this, let me teach you something most people don't really understand about markets. Prices don't always move because someone changed their mind about value. Sometimes prices move because someone ran out of oxygen. Leverage is oxygen. When you borrow to hold a position, you're fine until the room pressure changes. Then suddenly, it's not about conviction anymore. It's about survival. Think of it like being forced to sell your house not because you hate it, but because the bank just changed the rules overnight. That's what margin does. It turns normal selling into panic selling. And when you see a straight down candle like we just saw, your first question should always be this: was this choice or was this forced? Here's how it works in simple terms. Let's say you control $100,000 worth of silver, but you only put down $20,000 of your own money. You borrowed the rest. That's 5-to-1 leverage. Now the price drops 10%. You just lost $10,000, which is half your actual money. The broker calls you and says you need to add more cash or they're closing your position. You don't have more cash, so they sell. Not when you want to sell, not at a price you like. Right now. At whatever price the market will take it. Now multiply that by thousands of traders all facing the same margin call at the same time. What do you get? A selling avalanche that has nothing to do with the underlying asset's actual worth. It's mechanical, it's forced, and it's predictable if you know what to look for. So what does that tell us? It tells us that when you see extreme volatility in a single session, especially when it breaks through key technical levels and then snaps back just as violently, you're probably looking at forced liquidation, not a change in fundamental demand. The price action doesn't reflect what silver is worth. It reflects who got caught holding too much leverage when the rules changed. And that distinction matters because one creates temporary dislocations you can learn from, and the other signals an actual shift in the market's view of value. If this is making sense, drop a comment below and let me know if you've ever been caught in a margin squeeze yourself. I read every single one. Now here's what's actually happening. Let me break down the sequence the way I'm watching it in real time. Silver had been crowded. Futures were leveraged. Then margin requirements jumped. When brokers increase the amount of cash you need to hold a position, they're not doing it because they're bored. They're doing it because they see risk. And when margin requirements go up, traders who were already stretched suddenly don't have enough capital to maintain their positions. They have to sell. Not next week, not when the market recovers. Immediately. That's the primary trigger. Once that selling started, liquidity thinned. Liquidity is just a fancy word for how easy it is to buy or sell without moving the price. When everyone's trying to sell at once and there aren't enough buyers, the price gaps down, hard. And once price broke key levels, the algorithms kicked in. These are computerized trading systems that don't care about your thesis or your conviction. They see a technical breakdown and they pile on. Stops triggered. Those are automatic sell orders that traders place to limit losses. When the price hits a certain level, boom, more automatic selling. And all of this fed on itself. That's the cascade. That's what forced liquidation looks like. It's not one thing. It's a sequence of mechanical events that compound into a price collapse that looks insane if you don't understand what you're watching. But here's the secondary confirmation, and this is where it gets interesting. Reports surfaced that JPMorgan Chase closed out short exposure right near the lows. Now, I'm not here to tell you that's proof of manipulation or some grand conspiracy. What I'm telling you is that when a major institution covers a short position, that means they're buying. And when they do it near the lows of a violent move, that's not random. That's strategic. Add in temporary system outages at the London Metal Exchange and HSBC, trading platforms going down during extreme volatility. That's not normal. That's stress. The paper market, the futures and derivatives side of silver, looked stressed, not calm. And when the paper market is under pressure, it disconnects from the physical market. You get pricing dislocations, you get wild swings. That convergence matters. It tells you this wasn't a clean, voluntary repricing where everyone calmly reassessed silver's value and decided it should be lower. It was pressure, mechanical, structural pressure. And when pressure releases, price snaps. But here's the part that should make you nervous and excited at the same time. This mechanical flush happened just as governments started treating silver like a strategic asset. Not a commodity, not a trade, a strategic asset. And that changes everything. Because when something crosses the line from being a cyclical input into being a geopolitical tool, the entire pricing structure shifts. The demand profile shifts, the holders shift, and the volatility doesn't go away, it just changes character. It becomes the cost of admission to a longer-term repricing, not a signal that the thesis is broken. Zoom out with me for a second. The US didn't just casually announce Project Vault, a $12 billion critical minerals stockpile. That's not a press release, that's a policy commitment with funding attached. And it's not happening in a vacuum. The US is hosting a critical minerals ministerial with more than 50 countries. At the same time, the European Union is offering a minerals partnership. That's not coincidence. That's policy alignment across multiple sovereign states. When policymakers move from words to stockpiles, when they go from speeches to actual budgets and international coordination, markets eventually follow. You saw this exact pattern before. In the 1970s, when oil became a strategic reserve after the Arab oil embargo, what happened? Oil didn't just bounce back to pre-crisis levels. It got repriced higher, permanently. The 1973 oil shock sent prices from $3 a barrel to over $12 almost overnight. But here's what most people forget. After the initial spike, oil settled into a range, then moved higher again in the late 70s. By 1980, oil hit nearly $40 a barrel. It never went back to $3. Why? Because once a commodity becomes strategic, once governments start stockpiling it and treating it as a national security issue, the baseline demand structure changes. It's no longer just about industrial consumption. It's about availability. It's about control. It's about making sure you have access, regardless of price. You saw it again with gold after 2008. For decades, central banks had been net sellers of gold. They treated it like a relic. Then the financial crisis hit, trust in the system fractured, and central banks flipped. They went from sellers to buyers. What happened to gold? In 2008, gold was around $800 an ounce. By 2011, it hit $1,900. And even after it corrected, it never went back to pre-crisis pricing. Today, it's over $2,000. Why? Because when central banks accumulate, they don't trade, they hold. That removes supply from the market. It creates a floor. Every time a commodity crosses that line from cyclical input to geopolitical tool, it gets repriced higher, even if the road there is volatile, even if it scares people out along the way. This is the exact same playbook we're watching now with silver. Forced selling creates the air pocket. Policy creates the floor. And if you look at the pattern, metals don't just bounce after these events. They establish higher nominal lows. After the oil shocks, prices never went back to pre-shock norms. After central banks accumulated gold, gold never returned to pre-crisis pricing. Zoom out and you see that volatility doesn't negate the trend. It confirms it. It shakes out the weak hands. It flushes the leverage. And then the structural buyers step in. The larger story here is that strategic demand doesn't care about your entry price this week. It cares about availability over decades. And that's a completely different buyer profile than a speculator trying to catch a 3-month move. Now, before we go further, let me be skeptical for a moment because I want you to hear independent thinking, not just hype. Could this be wrong? Absolutely. Markets can overshoot in both directions. Could the narrative around strategic stockpiling be overblown? Yes. Could this entire move just be speculative froth that collapses back down? Maybe. Could there be manipulation, some grand conspiracy by institutions shorting silver into oblivion? Possibly. Here's the thing, though. It doesn't actually matter whether there's a secret cabal in a dark room plotting against retail traders. I'm not saying that to dismiss your concerns. I'm saying it because focusing on motive instead of mechanics is how you lose money. You can't control what institutions do. You can't control what governments decide. You can control what you watch and how you react. The mechanics are what matter. Focus on what you can control. Watch price behavior. Watch policy commitments. Watch physical demand. If this move was purely speculative, if it was just retail piling in on hype, it won't hold 85 to 90. It'll collapse back down as fast as it went up. If it was structural, if there's real underlying demand from strategic buyers, dips get bought. You'll see higher lows form. You'll see consolidation instead of collapse. Skepticism doesn't mean disbelief. It means discipline. It means you demand evidence before you commit capital. And that's exactly what you should be doing right now. Don't believe me. Don't believe anyone. Watch the price, watch the volume, watch the policy follow through. Let the market prove it. There are probably 3 types of people watching this right now. The first is the trader who got shaken out at 78 and feels absolutely sick right now. You bought silver higher, you held through the drop from 120, you told yourself you'd hold, and then when it hit 78, you couldn't take it anymore. You sold. And now it's back at 90, and you feel like you just handed money to someone smarter than you. If that's you, breathe for a second. You didn't miss intelligence. You got caught in mechanics. You were facing a forced liquidation event driven by margin pressure and algorithmic selling. And your position got stopped out, or you panic sold because the pain was too much. That's not a character flaw. That's what leverage and volatility do. Your job now is not to revenge trade your way back in. Your job is to stop, step back, and start watching structure. Where does price consolidate? Where does volume dry up? Where do buyers step back in? If you chase this move higher out of emotion, you're going to get hurt again. But if you watch patiently and wait for evidence of structural support, you'll get another entry. These patterns repeat. You're not out of the game. You're just learning an expensive lesson about position sizing and risk management. The second type is the long-term holder who didn't sell and is wondering if this changes anything. You've been stacking silver for years. You wrote it down from 120. You didn't flinch at 78. And now you're watching it bounce and you're thinking, okay, does this mean I was right all along? Or am I just lucky that it bounced and I should take profits now before it drops again? Here's what I'd say to you. This validates the thesis, but it demands patience. If you believe silver is being repriced as a strategic asset, if you believe government stockpiling and industrial demand for green energy and defense applications create long-term structural support, then this kind of volatility is the cost of admission. It's not fun, it's not comfortable, but it's part of the process. The long-term holders who made generational wealth in gold didn't do it by trading every swing. They did it by holding through the noise and adding on dips when they had conviction. Your job is to separate signal from noise. The signal is policy alignment and physical demand. The noise is day-to-day price action driven by futures traders and algorithm. If your thesis hasn't changed, your strategy shouldn't either. But if this shook you, if you realize you're holding more than you're comfortable with, then use strength to trim, not weakness. The third type is the skeptic who thinks this is all noise. You don't own silver. You think it's a boomer metal with no real use case. You think the people talking about strategic stockpiles are conspiracy theorists. You're watching this video because you're curious or because someone sent it to you, but you're not convinced. That's completely fair. If that's you, don't buy the story. Watch the levels. Let price prove it. If silver can't hold above 85, if it collapses back to 70 or lower on heavy volume, you were right. It was hype. But if it consolidates here, if it builds a base and starts moving higher on declining volatility, maybe there's something to it. You don't have to commit today. You can watch and learn. The universal principle for all three of you is the same. React to evidence, not emotion. Whether you're in, out, or on the sidelines, the market doesn't care about your feelings. It cares about supply and demand, leverage and liquidity, policy and fundamentals. So here's what I want you to answer in the comments. Which type are you? Are you the trader who got shaken out, the holder staying patient, or the skeptic watching from the sidelines? Let me know, because I read these and I genuinely want to understand where you're coming from. So here's where I stand personally. I'm not chasing candles. I'm not buying silver at 90 because it went up 12% in a day. That's not how I operate. But I'm not panicking either. I'm not selling into strength just because the move feels too fast. I'm watching three things very closely. First, I'm watching whether silver holds that 85 to 90 zone as support over the next few sessions. If it pulls back and finds buyers in that range, that tells me there's structural demand stepping in. If it slices straight through on heavy volume, that tells me the bounce was technical, not fundamental. Second, I'm watching whether we reclaim 95 to 100 and start to realign with Shanghai pricing. Shanghai has been trading at a premium to Western exchanges, which tells you physical demand in Asia is real. If New York pricing starts to converge with Shanghai, that would confirm global demand is supporting this move, not just speculative positioning in one market. Third, I'm monitoring whether any deeper washout towards 70 to 75 happens on declining volume. If price dips but volume dries up, that would signal exhaustion. It would mean sellers are done, and that's when structural buyers tend to step in. Based on my analysis, this move was mechanical, not emotional. It was driven by forced liquidation, margin pressure, and algorithmic selling, not by a fundamental reassessment of silver's value. The fundamental picture didn't break. It arguably strengthened. You've got government policy aligning around critical minerals. You've got physical demand from solar, EVs, defense, and now strategic stockpiles. You've got supply constraints that haven't gone away. None of that changed because futures traders got squeezed. If anything, the mechanical flush cleared out weak hands and reset positioning, which could set up the next leg higher if the fundamental thesis holds. If history rhymes, and silver follows the pattern we've seen in oil and gold, when they transitioned from cyclical commodities to strategic assets, the move that follows could dwarf what we've seen so far. But I'm not making predictions. I'm watching evidence. I'm not a financial advisor. This is not financial advice. I'm not telling you to buy silver, sell silver, or do anything with your money. Do your own research. Verify everything I've said. Check the data yourself. Talk to people smarter than me. Make your own decisions based on your own risk tolerance and your own financial situation. What I'm giving you here is my framework for how I'm watching this unfold. That's it. If you made it this far, you're the type of person who doesn't just react to headlines. You think critically, you ask questions, you demand evidence. That mentality will serve you well, not just in silver, not just in markets, but in every decision you make. If you found this valuable, share it with someone who needs to see it. Subscribe if you want more breakdowns like this, and stay ahead of the noise. Think critically, verify what you hear, and make your own decisions. Stay sharp out there.